It was around mid-August this year, if I'm not mistaken, when the news dropped, TnG Digital has hit their first ever profitable year and unicorn status at the same time. They were sitting the headlights. But something felt off, like really off. From the way the organization operates, especially on product, I've always felt sort of like this thing isn't that easy to steer to profit. My best friend once asked me, bro, how is TnG Digital still losing money when they have 20 plus million users across nationwide? I end up not answering that question. Well, my instincts told me the whole answer is just a part, but that justification needed to prove my thesis. Hence, I drop out this episode. From math calculations to justify profitability to the actual product logic, I will answer the questions. So let's dive into it. When CIMB CEO Ruby Singh came out and said that TnG Digital has hit a $1 billion valuation threshold and turned profitable, it sounds impressive. It sounds big. But the moment I heard it, something didn't feel right. You know that feeling when the headline is loud, but the logic underneath is shaky? That's actually what I feel. So I took a step back, look at the whole thing carefully, and honestly, the claim just doesn't hold water without proper justification. So here's the two parts: the valuations and profitability. And the valuation is one thing. It is subjective. It depends on investor psychology, and without transparent financing data, it is impossible to verify. But profitability is different. Profitability is something you can reason through. It is something you can test against financial data, especially when the numbers for 2023 are already public. And since the company was still reporting losses in that year, the only proper way to judge whether profit next year is to calculate the break-even point. Basically, it refers to how much revenue they need to cover their expenses and reach to zero profit. Let's look at the number. In financial year 2023, TnG Digital reported 224.4 million total revenue. Their gross profit was 32.9 million. Their net loss was 119 million. And the total operating expenses plus other costs add up to 232.9 million. So we get those numbers, but before we really dive into the calculation of break-even point, we need to find out a key figures here, or maybe the indicators here, which is a gross margin. So we need to calculate the gross margin firstly. So the formula of gross margin is we need to take the gross profit divided by the total revenue times 100%. So here, we take 32.9 million divided by 234.4 million. So by doing this, we'll get around 14%. That means for every ringgit of revenue, they only keep 14 cents. For a tech-driven company, there's extremely low efficiency. So now, with the percentage of gross margin, we can calculate the break-even point. The formula of calculating so is, we need to take the total operating expenses plus the other costs, divided by the gross margin. And here's the most crucial part. If you take your total operating expenses plus other costs, which is 230.9 million, and divided it by 40% of gross margin, you get roughly 1.59 billion ringgit. So what does that mean? That means TnG Digital needs 1.59 billion in revenue just to break even, which means profit equal to zero, the lowest profit we could ever make other than losses. And to be honest with you, this figure is about 7 times their revenue in 2023. If the math looks brutal, that's because it is. But that is the math. Simple as that. What does this tell us? It tells us that the profit claim is far more narrative than substance. If anything, it raises and bigger questions. How did a company with monopoly-like advantages still fail to turn a profit for so many years? And even more importantly, what kind of structure these ends are they actually trapping? To date, as we can see, the digital app itself has full of services, either financial-related services such as Gold Plus, Visa card or insurance, or non-financial services such as Metrico, Carol, Foodpanda, you name it, which is a collaborative with third-party services that bundle with only touch and go payment allowed as default if you want to use that service through this digital app. So there's nothing you can ask for, only what you can imagine inside the app. And we called it a super app. The terminology refers to a single mobile application that consolidates multiple services and features. It can be denied that this concept of super app has provided a lot of convenience at a certain point. Like, a lot of routine activities can be done in a single digital payment app. Yet, that is what I so-call the dead end of TnG Digital, which they are facing off recently. I know that some of you might be like, what the fuck, bro? That's too convenient. Don't tend to provide such normal things. Well, it is convenience. I need to admit that. But if you are expected to hear a point of view on TnG Digital business model in a general lens, or have kind of pricing tendencies of support local narrative like what most media podcasts do, then this episode is not tailored for you, unluckily. But if you are a builder or individual that has genuine curiosity, wondering what kind of mistakes that leads to several years of losses, and still making vague and arguable announcement on the firm's profitability, please continue for listening. So, if a sentence is more than enough to define the failure of TnG Digital business model, it should be the lack of the product flywheel effect. What does it mean by the product flywheel effect in this context? It means a cycle of flow within the features that make them inextricably linked. And every round of cycle generates a snowball effect on data and revenue stream that later reflect on the company's revenue ability and sustainability. Mostly, the features in the app is operated in siloed way. I will choose 2 of all of the features or product to illustrate my thesis. So firstly, we talk about Gold Plus balance. It is kind of 7 features in this digital payment app. So how it works in details? A quick one. First, we may enable the quick cash-in function at the Gold Plus dashboard under the setting stations. By enabling this, the consent system to automatically transfer amount from our e-wallet to the Gold Plus savings account. Then, we need to get our available transferable balance in the e-wallet balance, at least more than 10 ringgit. This is a trigger conditions which once our balances exceed 10 ringgit, the system will automatically transfer the entire amount above 10 ringgit to the Gold Plus savings. For instance, if I have 25 ringgit in the balance, 25 minus 10, which means there will be 15 ringgit we will transfer to the savings account and earn more interest. In addition, users can turn off the quick cash-in and choose how much transfer to the saving fund manually, so long as it is more than 10 ringgit. The problem is that manually top up is the only way users convert that balance to savings. That said, the feature isn't designed to encourage saving behavior. Instead, we'll just make it the siloed saving features. Why not inject some compounding logic into it? So I will take an example here. What Revolut do, which is one of the biggest payment platforms based on London. Instead, they're connecting the user's payment and saving behavior with the features so-called the spare change roundups. The feature is kind of round up to save method which the system automatically round up users' transactions, which then transfer the preference into the user's regular pocket or saving account, or to purchase cryptocurrencies, or maybe earn rewarding points, which is the rare points. And then, crucially, users can earn certain amount of interest rate from there. Why is it important? Because every time they're spending, they are saving at the same time. This encourages them to make more payment through this platform, which eventually increases the volume of transactions. As a result, more users' data can be collected for later utilization or iteration of the product. Each action users take in the app fills another action automatically. For example, every time users spend, they save a little. They earn rewards, and that motivates them to spend again. Thus, we could get more data from the users. Get more data means we could understand more about user behavior and help to produce higher tailored product. This is kind of a self-reinforcing loop. But in Go Plus, the spending part and the saving part are disconnected. Users must consciously move money themselves. Nothing in everyday payments naturally fits into the savings. So there is no compounding behavior at all, no continuous loop, just separate features living next to each other. Come to the second example, which is the insurance part. TnG has partnered with some of the big names in insurance industry, Allianz, AIA, Tagafu, Zurich, and so on. And by the collaborations, one-stop solution is embedded in the e-wallet app, where users can get the quotations and buy plans from the insurer. But while it is still considered a siloed product, the thing I noticed from several plans is a plan so-called the wallet safe, which is kind of protections on our wallet, e-wallet, and Go Plus balance. The plan itself used to protect us from unauthorized transactions, deaths due to accidents, and mobile device theft, which is a certain amount of monetary coverage. One thing that made me feel off is that, why would a platform with electronic payment as a main cause positioning the wallet protections coverage as luxury demand or premium add-ons instead of a necessity demand, by launching the wallet protection as the specific independent insurance product? So, what if making this a high urgent one by embedding this wallet coverage to all of the plans that says everyone that sign for any kind of insurance plans from TnG Digital app automatically enjoy the wallet protection coverage. With this, rather than facing off digital fatigue to decide whether to add on the wallet protections, users treat it as a must. This is crucial because wallet protection itself will make the plans attractive. Buyers are more willing to buy. Hence, this might increase the purchase intention and lower down the CAC, which is the customer acquisition cost, increase the LTV, which is the lifetime value, strengthen the trust, grow transaction volume, give you more data, and lead to better product design. Most importantly, marketing which the part the money burned the most by TnG Digital is done by base rather than further allocation on model or marketing. But obviously, it is costly when not doing so. That is, we are fragmenting user experience and fragmenting on marketing budgets at the same time. Each new siloed product, whether it is Go Plus, insurance, or wallet protections, all needs its own marketing narrative. Its own user education effort is needed as well for raising brand awareness. That effort alone will multiply your CAC because You are paying repeatedly to acquire the same users, but for the different features. Rather than compounding on an existing trust loop, the worst is that users don't build habit or emotional attachment to the ecosystem. They see each product as a separation agent, not as a seamless extensions of their wallet. That lowers cross-sales efficiency, weakens retention, and forces the company to rely on more cash burn campaigns just to sustain their business. In short, siloed launches meant higher marketing costs, fragmented user data, slow adoption, and zero compounding logic, which is the exact opposite of a true flywheel is supposed to do. Apart from those silo features we discussed, some of the features we contacted with in a daily basis like tolls, payments, and etc., most of them dragged on as well. Let's take a very new example to me. Remember that they enable tools payment via app deductions, but that is not for all the tools. Hence, I still need to ensure I have balance in the cart. Yet, they didn't load direct top-ups or prepaid cards via the app. That said, I had to find kiosks and reload during limited hours. Bloody hell. Then, they come with NFC reload card, a kind of card that enables reloading via NFC-enabled phone, which users can place the card on the back of the phone and follow the prompts to choose a reload amount and confirm the payment. It is 5 years after TnG Digital emerged, and even itself raised my anger when it can't be detected by the app sometimes. Alright, there's a part of its product. Still, there are a lot of these examples that are worth to be unpacked. Yet, that's too much for an episode. The question is, do they really need 5 years of time to come out with a bad solution? What we have, as we can see, instead, it's a face-level innovation that hardly moved the needle. Features are dragged on for years. We fail on execution. Yes, the keyword here, which is execution. Put the product building discussion aside, take a step back, and it is obvious that what's underlying beneath the hood. That is, the bureaucracy behind our organization. As the starting point, TnG Wallet served as a joint venture by the parent companies, TnG, Shenyuan Berhad, and Ant Financial, which is from the Ant Group, the subsidiaries of Alibaba. While CIMB is the largest shareholder since CIMB serves as the backend of the TnG, and CIMB itself is controlled by the Qatar National. Look, the backend is congested. While we're having too much to diversified authorities on our back, the situation of misalignment of incentive must be occurred. Imagine this. CIMB views the wallet as a customer acquisition tool that should fit banking and lending, and views it as a data platform that monetizes behavior and ecosystem logins, while insurer AIA views it as an insurance distribution channel. Ultimately, every major product decisions becomes a negotiation, not an iteration, because nobody owns the right to speak, and everyone is guarding their lanes. When a platform has too many backends, multiple shareholders, tech stacks, regulators, and revenue masters, it stops behaving like one organism and starts behaving like a coalition of semi-aligned fiefdoms. As a result, we never see features that hit product market fit and unlocking market welfare in the real sense. More likely to be, all the side of product we see now are the byproducts of negotiations. The bigger lesson here is Malaysia's missed chance to build a national fintech ecosystem, just what China did on the Alipay. This was the country's first fintech product with a monopoly like Moz and could have digitalized services to make life easier for Malaysians. That didn't happen anyway. Instead, TnG path mirrors the red tape and slow pace of tech adoption in Malaysia. What we consider slightly unlucky is that we are having an attitude that having too much already on their back, which lack of builder mindset that possess the mission to build a better financial ecosystem and maximize potential market welfare. All right. It's near to the end, and on that, of course, TnG Digital isn't a startup. Instead, it is a corporate offspring with government concessions. It sounds like far-fetched from the start from the lesson, isn't it? Well, that is exactly why the lesson matters. Whether we are giant or small, the rules of compounding are the same. If we don't build kind of product loops that lead to sustainable of business model, we end up in a dead end. As a startup founders, we can't afford to make that mistakes, or more precisely, repeating the mistakes that hardly helped our learning loop. Because we don't get decades of monopoly. Plus, we don't even have the luxury of a bureaucratic relationship to fall back on. But what we are missing, that is what raw superiority adds in the first place. Non-granted monopoly means we earned every inch of progress through what? The actual market validation and user value. No bureaucratic relationship means we could think, build, listen, and iterate all with the fast pace, without all those fucking hierarchy and culture that used to preserve like it is a joke. But the most crucial one, the works of defining market problem, hiring the right person, use the right way to build and iterate it, shaping culture within the organization. It's all about science. That said, we as a startup founder or value creators need to approach building in a very scientific way more than ever before. Enthusiastic and theater performing itself couldn't get us further, but instead backfire on ourselves. So of course, it is not just all about the intention, fancy slogans, narrative that shape around, kind of story-based belief. But instead, it requires forming hypotheses, running real experiments, measure results, and refine the system until it works. Comment section down below, open for discussion. This is why it's so-called Power Than Lab, and this is what I do here. See you.